Hello students, Dr. Wang is here. In this chapter, we're going to learn how to control our inventory and how to count for cost of sales. So if you still remember, in chapter 5, we learned how to get the inventory in accounts, in particular, how to put in the cost goods sold. And now we are going to learn how to get out the inventory when sales occurred. So here are the topics covered in this chapter. However, I'm not going to cover all of them. So just study the topics that are presented in this video. So first, you need to identify the items making up the merchandise inventory. So right here, you have a merchandise inventory. Includes all the goods that the company owns or holds for sale, and regardless where the goods are located when the inventory is counted. So you could have a goods in transit, it's still during transportation, or goods on consignment, or the goods at the agent of your employment, and also the goods damaged or obsolete. So obsolete means it's out of date. So we have learned the goods in transit. So basically we have a seller and a buyer. We have a FOB shipping point and FOB destination point. So if it's the shipping point, then the owner take care of the transportation. If it is a destination point, then the seller will take care of the transportation. And depending on your owner or seller, you will build the transportation cost into your accounting system. How do you identify the inventory cost? So first of all, there's the invoice cost. So basically that's the full price of your merchandise. You need to minus the discount allowances, and also you need to plus the inventory, plus the insurance. You also need to plus the storage fee. You also need to add the shipping fee. So not just the full price of the merchandise, but also the cost associated with the merchandise for making it available for sale. And also you need to deduct the discount you give to the buyer and also allowance you give to the buyer. All right, so the inventory cost system could be plugged into the balance sheet and also income statement. And we call it a perpetual system because each time when new inventory is built in or some inventories are sold off, we have to update our accounting system. So we do not do it on a periodical basis. We do it transaction by transaction. So here is the basic steps for making the decisions. So you have items including inventory and their cost. That's the first thing you need to figure out. And also you need to know what costing method you are using. So there could be a first in, first out, last in, first out, or weighted average. And then you will decide whether the inventory system you use here is a perpetual or periodic. Since we do a lot of practice here, and the perpetual system would be more advanced for us to do the practice. And also you need to use the market values or other estimates. So how many of the companies are using first in, first out for the costing method? Mentioned in part 2, that's a 48, nearly half. And about 28% using last in, first out, and 20% are using weighted average to count the inventory cost. All right, so why we have these 3 methods? So here is the different 3 methods in comparison. So let's say for a company, each time they import the inventory, the cost is at different level. So sometimes the cost is 45, sometimes 65, and sometimes 70. All right, so just because the inventory cost at a different amount for different dates, and also you need to decide which inventory should go first, and that depends on what industry you are in. Are you in the food industry? So basically, if you're in the food industry, your merchandise got a rot very quickly, so you need to sell the first in one for money, right? You don't want to sell the freshest. Actually, you want the oldest food is your priority to get rid of. And the second is the last in, first out. So let's say if you're in the furniture industry, and it's very hard to move the furnitures of your merchandise. So the first merchandise are stored deep in your warehouse, and the newest furnitures are very close to the door, and that's much easier to move. So your strategy is to get rid of the new furnitures because just they are easy to move. All right. If you're not sure what method to use, you can always use the weighted average. So let's look at the income statement. Let's say if the sale of your products for one block, okay, there are 3 blocks here, is $100. All right. If you use the first in, first out method, then you get rid of the oldest inventory, okay, which was purchased on May the 1st. If that's the case, then your cost of goods sold will be the cost of May the 1st merchandise. That's $45. And then your cost, your gross profit will be $55. And afterwards, your balance of inventory will be $135. So which is the merchandise purchased after May the 1st. So that's a 65 plus 70. So that's the first in, first out. The next method is last in, first out. So again, you put one block, 2 block, 3 blocks in 3 consecutive days. And then based on this method, last in, first out, you sell first the last merchandise. So that is $70 at its worth. So in the income statement, your cost of goods sold will be 70. All right. And then you still have the net sales because you are still selling the same products, but your gross profit drops because the cost of goods sold increased to 70. And on the balance sheet, the remaining of your inventory will be this 1 block, 2 blocks, so they add up to $110. You can also do this. We call it weighted average. So that means when you make the sale and you have 3 blocks of merchandise, you just get 1/3 from each block. Okay, get 1/3 from each block. So in total, you have you have spent $180. So that's a 70 plus 65 plus 45. That's $180 for all the merchandise you have purchased for all 3 blocks. And then you divide it by 3. So that basically means for each unit, you pay $30. Okay, you pay $30, and then you just sell 1 unit or 1 block. So that block comes from the first block, second block, and the third block, 1/3 from each. So you just deduct the weighted average of $60 for the cost of goods, and then your gross profit will be $40. And your remaining inventory is always the initial value of 180 minus whatever the cost of goods sold is right here. All right. Remember in chapter 5, we learned how to do merchandise. So the beginning inventory plus net purchases, that will be the merchandise available for sale. And if you count the ending inventory amount, then that the disappeared ones will be the cost of goods sold. All right, here is an example. So let's say for a series of days, there is a purchases and there are sales. And you have a beginning inventory, and that's 10 units. And the beginning inventory has a total of $910 at cost, because when you purchase those inventory right here, it costs you $91. And then you keep adding inventory on the next day. You purchased 15 units, and then the price is actually $106. And your unit inventory is add up to 25. It's a 10 plus 15. And then on the 14th, you make a sale. You sell 20 units. So the price is 130. So basically, after 20 units are gone, your remaining inventory is left to 5 units. And then you make 2 consecutive purchases right there. You have 20 units purchased on 17th and 10 in 18th. They all at different price, and you can get the total cost easily just by multiplying units by cost. And then you will also have more and more inventories after these 2 purchases. And then on the 30th, you will sell 23 units of it at a $150 price. So the remaining inventory will be 12. It's pretty easy to count how many units you have after a purchase or sale. And also it's pretty easy to calculate the total cost for each purchases and the total revenue for each sales. All right. But we need to know that how do we count for cost of goods sold? Because for cost of goods sold, it could be different depending on your costing method. All right, if you use the first in, first out, or last in, first out, that would pose different numbers for your cost of goods sold. But for total revenues, it's always the same. If you use the first in, first out method, then the oldest costs will be incurred. So basically, go with the old merchandise first, and that will be put as cost of goods sold. And then you do not touch the new merchandise, so the recent cost will not be incurred. It will not get out for the merchandise. Then that will build into ending inventory. So this basically shows you how the goods flow when you use this costing method. So basically, we have the same story, same beginning balance, same purchases, and also same sales. So right here, you need to sell 20 units. Okay, you need to sell 20 units, and you have a inventory of 25 units. So if that's the case, if you use the first in, first out, you will get rid of the first units. So the first 10 inventory is here. That's something you need to sell first. That's you need to put a priority on. And then you will sell the second block. So this is 15 units there, but you don't need to sell the 15. You only need to sell 10 of them. Okay. So basically, the 20 units you sell here come from a 10 in the first block. So after first block is depleted, it's all used, all gone. Then you start to get merchandise from the second block. And again, when you count for cost of goods sold, you use the price for the merchandise, 91 here and 106 here. So that's how you compute cost of goods sold for this sale. All right. And then you have another sale right here, another 23 units. So basically, that means still you need to go with the oldest merchandise. Remember, after the sale, the first sale, we still have 5 units left. Do you see the inventory balance after the first sale is a 5? So that's a 15 minus a 10, so that's a 5. And then the 23 units will go to first, you need to get rid of the remaining 5, and then the rest will go to the other units. And right here, you purchased 20 units, so that means you need to get the rest of 18 units from this 20. Okay, so when you sell 23 over here, 5 actually come from this block of purchase of merchandise, and another 18 comes from this block. All right, and you don't use any merchandise from here because it's all gone. All right, so you calculate the cost of goods sold, so that's how much you have. And then how much get left for you in terms of inventory? Well, this block is gone, this block is gone, and for this block, 18 of 20 is gone, so only 2 got left. And then for this block, it's untouched. Okay, so still 10 there. So the remaining inventory is 2 from this block and 10 from this block. Of course, you need to multiply the price in. All right, so for last in, first out, that means you need to get rid of the new merchandise first. So that will be your cost of goods sold, and the old merchandise will stay at your inventory. So let's say in this case, same purchases and the same sales, and we'll make a 20 sales right here. Then that 20 will first come from the newest purchase, which is right here. So that's 15. So you're gonna use all 15 units. Okay, you're gonna use all 15 units here. Does 15 satisfy your 20 sale? No, you still need to find another 5 units. So that 5 units will come from the beginning inventory, okay, out of 10. So your cost of goods sold will be 5 from the first package, and then 15 from the second package. And of course, you multiply by the cost. All right, and then this sale, you have another round of sale. So that's 23 units. Once again, we use a last in, first out. we want to get rid of the newest inventory. So the newest inventory from this August 30th sale is August 28th purchase. So you need to get rid of this 10 units in this package. And then you still have a 13 to go, right? So you sell 23 and 10 is taken care of. You still need to find 13, and that 13 will come from this 20. So 13 out of the 20 will go to your sales. So that's how you compute the cost of goods sold. And how many got left? So from this block, so it's not completely gone because you only get 13 of it, so 7 got left. And this block is gone, and also this block is gone, right? So the beginning inventory also got some left over. So that is that is 5. So your eventual inventory balance is 5 from the beginning balance, and also 7 from the purchase on August 17th. So if we use a weighted average, then we need to use the total cost of goods sold divided by the units on hand. So what you have here is, well, this is your first sale, and you're going to use the products in 2 blocks. So you need to know how much it costs on average. So the first thing you need to do is to get the weighted average cost of your units for each one. So you have $10 for the first block, and 10 units for the first block, and 15 units for the second block. And then you get the summation, so that will be 2,500. And then you use 2,500 divided by 25 units. So 10 plus 15, that's 25. So that gives you $100 per unit. So that means for your sale on the 14th, when you sell 20 units, so that will come from partially the first block and also partially from the second block. And on average, each unit will cost you $100, right? It will $100. So that's your total cost of goods sold. And you know you have 5 units remaining. After 20 is gone, you still have 5. And then if you count the inventory balance in dollar amount, you're going to again use the cost per unit by the remaining number of units. Okay, so these are the calculations you need to follow. And then we'll make the second sale. So basically, you first need to calculate the inventory cost at per unit level. So when you have this purchase, second purchase, 20, and after 20 is purchased, and your price structure has changed. So it was a 5 each at $100. Now it's 20 at $115. So you need to get the total cost. So you will use 5 times 100 plus 20 times 115. So that's going to be 2,800 or 112 each. So use 2,800 divided by 25. That's 112 each. So that will be your new cost per unit. Okay, and then you will make another purchase. So after the second purchase, then your total cost will add up. So this is how much the second purchase will cost you. So your remaining inventory now is 25 plus 10, that's 35. And for these 35 units, 2,800 is the total worth of the first 25. And you also need to add the worth of the next 10 units. So 25 times the value each times 10 times the value here for the new purchased inventory. So you get your total divided by 35, that's 114. And then you make a sale of 23 units. So when that sale is made, so that 23 units will not discriminate whether it's coming from here, the second purchase, or the third purchase, or even the first purchase. Actually, you get the inventory from all blocks, even including the beginning inventory. So what you see here is when you make the 23 units sale, so the cost each is $14. So you just to keep updating the price per unit each time you make a purchase and each time you make a sale. So that's your price per unit. All right. So this would be your total sales, total cost of goods sold based on the weighted average system for inventory cost. All right. And for this chapter, this is where I end. So I just teach you all the cost method. So that's the end of chapter 6. And for the remaining contents, you can go ahead and read it from the textbook or from the PowerPoint file.